In this discussion, we will explore the job tasks associated with projecting client cash flows and creating cash flow performance statements. By the end of this lesson, you should be able to describe the process of projecting a client's cash flow situation for the upcoming year and project your client's pro forma cash flow statement. The concept map on this slide depicts the systematic flow of activities that you'll be engaging in when projecting client cash flows. The first step is to understand the client's historical spending patterns. You need to see where the cash has been coming in from and how it's been used. Cash flow analysis can tell us a lot about your client's priorities, needs, wants, and values. Ideally, it would be great if you could accumulate 3 years of data because it would allow you to see patterns in one-time windfalls or one-time expenditures. However, it's more likely that you'll be starting from just 1 year worth of data. The next step is to make reasonable adjustments to the prior period. This will require you to make assumptions, and you'll certainly need to have a conversation or two with your client about their expectations for the coming year. What insights can you get about future earnings and expenses? Are there any capital spending wishes in the foreseeable future? Does the client expect any life transitions that would significantly alter the spending patterns? Asking questions like these are important if you are going to create useful pro forma statements. Ratio benchmark data may also be a useful tool in projecting cash flows, particularly if your client has committed to maintaining a reasonable budget. With this information, you can draft a pro forma of cash flows. And with that draft, you are ready to engage the client in a constructive conversation. What does the client think about the projected data, particularly the expenses? Where is the client willing to cut back in spending? Does the client have any new information to share that would impact and alter the cash flow projections? Based on that client feedback, you'll be able to finalize your pro forma and use it for budgeting. Now, variance analysis is this term given to tracking differences between projected earnings and spending and actual earnings and spending. Where were the meaningful differences? What happened and why? This information is incredibly useful data, which will be used in future planning meetings and for creating the next set of performance. Let's now focus on each of these steps in more detail. The format of the sample cash flow statement depicted on this slide should look familiar. It breaks out income and expense by type and category. For example, fixed, variable fixed, and discretionary expenses. To fill in the numbers, you'll need to gather a variety of client data, including the W-2 earnings statement, dividend and interest statements, credit card itemizations, mortgage statements or rental agreements, auto loan payment data, income tax form 1040, and insurance premium statements. Once completed, you understand the client's recent cash management decisions and you're ready to make adjustments. In projecting future incomes, you'll need to assess each of the income line items. What do you expect for future earnings? To answer that, you'll need to think about trends in raises, the trends in the annual commissions earned, and the number of hours worked. Might the client intend to take on a second job? Is there a good chance of job loss? Or might the client plan a career change that would disrupt cash flow for a period of time? What do you think about dividend and interest income? Have interest rates and dividend yields changed significantly? Has the investment account increased in value, or is it significantly lower because assets were used and they're no longer available to generate interest income. Do you project any material changes in passive income, such as rental income, royalties off a book, for example? Remember, you need to identify which incomes were one-time events that shouldn't be projected into the pro forma. For example, capital gains from the sale of a security. Similarly, you'll need to assess each of the expense line items. While fixed expenses are just that, fixed in the amount of outflow, you should check to see if something has changed to alter the fixed outflow moving forward. For example, a mortgage refinancing or debt consolidation resets the monthly principal and interest payment. Paying off a car loan eliminates that monthly fixed expense. Perhaps the county or city in which your client resides has changed the property tax formula, which will result in a new fixed expense amount. Variable fixed expenses, such as utilities or services, might be adjusted based on the cost of living inflation indexed. Discretionary spending is typically the category that has the most dramatic potential of change. Does the client have a capital expenditure or expenditures planned, such as paying for a child's wedding or purchasing a new car? Is the client willing to adjust lifestyle spending to save for future benefit? For example, might the client be willing to compromise on those luxury vacations? While it's not suggested that you try and project future income tax rates, you will be able to project income tax liabilities based on the impact of your planning recommendations. For example, assuming that the client adopts your recommendations to continue to fund their pre-tax 401k contribution, you know that the tax liability will drop because adjusted gross income will be lower. Similarly, consolidating credit card debt into a home equity loan will shift a non-tax deductible expense to tax deductible status. Let's examine this draft pro forma cash flow statement. The home mortgage is a fixed expense, so the expense in the prior period and the future period remains at $35,000. Not knowing what to expect about the car expenses, I'm assuming that expense is going to remain about the same, $1,500. The utilities and child care expense are variable. And you see that I've adjusted these, or adjusted the prior period numbers by the cost of living index. Here I assume 3%. There are three major discretionary expenses on the statement: vacations, entertainment, and contributions. For purpose of this sample, I made the assumption that after discussing the cash flow situation with the client, she or he was willing to make some adjustments. Notice how the contribution amount actually increased, because in this hypothetical situation, donating 10% of annual salary was a client non-negotiable. Remember, the client's always in charge of their cash flows. We're their advisor and advocate. Finally, I made the assumption that based on my planning recommendations, the client would benefit from a reduction in income taxes. Up to this point in the discussion, we've focused on projecting cash flows for the individual client. However, it's useful to see the interconnection between this and corporate finance. The image on this slide summarizes how a business could use historical data along with adjustments to project its future cash flow. Important historical data for a retail business include the prior year sales, the hourly sales data during the week, employee scheduling data, and expense ratios. That historical data could then be adjusted using current trends in revenues, expenses, and pricing. Calendar variations, for example, when holidays fall, change in marketing campaigns, and industry trend data. In this sample pro forma, you'll notice that last year's sales are projected to grow by 20%, which is significant. Cost of good represented 40% of sales last year, and based on the data in this table, the preparer expects that the percentage will remain the same. Therefore, 40% of the projected gross sales is $24,000. Notice how the general and administrative expenses and the selling expenses were 20% and 10% of sales, respectively. You could use those percentages in the next period, and based on the higher sales, you would project sales or expenses of $24,000 and $36,000, respectively. Of course, management would hope that economies of scale might allow the expenses ratios perhaps to drop to 18% or 9%, respectively, which would lower the dollars spent. Do you see how the process for business based on a percentage of sales method is the same as we've explored in this model for the individual planning client? The format of this table offers a side-by-side comparison of projected budgeting dollars and the actual dollars spent. This is the same process for both financial planning and for the financial planning professional and the business manager. Where were the meaning variances, either positive or negative? What caused the difference? If the variance resulted in overspending, how can it be improved moving forward? Feedback is incredibly important, whether in advising with our clients, teaching, or in management. In this lesson, you learned about the process for projecting client cash flows. You learned about important adjustments you'll need to consider when projecting future cash inflows and outflows.